Welcome, everyone, to Ollie's Osher Lifelong Learning Institute at UC Berkeley's Fall Speaker Series. I'm Susan Hoffman, Assistant Dean in Extended Education here at Berkeley and Director of Ollie at Berkeley. Today, we will hear from Professor Barry Eichengreen, who is a distinguished professor of economics and political science. He has served as a senior policy advisor for the IMF and been a research associate of the National Bureau of Economic Research and a research fellow of the Center for Economic Policy Research. His teaching awards have included Berkeley's Distinguished Teaching Award, and then there have been many awards that recognize him in economic history as well as a leading global thinker. His most recent book is The Defense of Public Debt, with colleagues published by Oxford University Press in 2021. And his forthcoming book, Money Beyond Borders, is coming out from Princeton University in March. Fun fact about Barry is that he was born and grew up in Berkeley, California. This session is going to be recorded, and as soon as it is captioned, we will send it to all those who are registered for today's talk. Please, if you have comments and questions, add those to the chat. And after Professor Eichengreen's presentation, we will respond to as many of your questions and comments as is possible. So please now welcome homeboy, Professor Eichengreen. Barry.
Thank you to Susan and to Ollie as well. I spoke to Ollie once before pre-pandemic, and it's very good to be back. Susan, after I told you that I was born and grew up in Berkeley, I recalled another fun fact, which is that my mother has spoken to Ollie as well. She spoke to it quite some time ago on a very different topic. So let me share my screen. Ollie has produced a very nice poster cover page for the talk, arguably better than the cover page that Princeton University Press produced for my book, which is the basis for this talk. Self-servingly, I note that it is available for pre-order at Amazon, barnesandnoble.com, etc. So the point of departure for this talk is the observation that the dollar is, of course, the currency of the United States, but it's also the currency of the world, that it is more widely used for transactions across borders in countries around the world, far and away more widely used than any other national currency. Other countries use the US dollar not just in their trade with the United States itself, but in their trade amongst themselves. Third country trade utilizes the dollar as well. A majority of global exports and imports are priced and settled in dollars. The dollar is the dominant currency used for international bank transactions when banks transfer funds across borders. The majority of those transfers are, again, in US dollars. The dollar is bought or sold in more than 90% of foreign exchange transactions worldwide. That's quite an extraordinary number, given that the US is something on the order of a fifth of the global economy. Our currency is far and away the dominant currency on global foreign exchange markets, and when central banks and governments hold foreign securities as reserves, the majority of those foreign reserves are held as US Treasury bills and bonds or US dollar bank deposits, by and large held, again, in this country. The fact that the dollar is the dominant international currency, I would argue, confers considerable advantages on the United States. American banks and firms enjoy the convenience of being able to do cross-border business, being able to do business globally in their own native currency, in a currency that is familiar to them. They don't have to worry about exchange rates moving against them because most of their international business is conducted in their own native currency. Our government is able to borrow at lower interest rates than it could otherwise, because there is this additional demand for US Treasury bonds out there from foreign central banks and governments that buy and hold those Treasury bonds when they seek to accumulate foreign assets, foreign reserves. The dollar is safe haven currency, meaning that people rush into it when something bad happens in a period of volatility. So the dollar and US financial markets strengthen rather than collapsing when that bad thing happens. So if you think back to 2008, when the investment bank Lehman Brothers chaotically failed, we in the US were responsible for the bad thing. And yet the dollar strengthened in the immediate aftermath. People didn't rush out of US financial markets. They didn't rush out of the greenback. Instead, they rushed in because the dollar was regarded as safe and secure, because US financial markets are the most liquid financial markets in the world. And finally, because such a large share of foreign savings is held in dollars and so many international transactions go through the US banking system, the US government possesses a powerful financial weapon in an economic or geopolitical dispute. It can freeze the foreign dollar balances of foreign governments, foreign firms, foreign oligarchs, as we did, for example, following Russia's attack on Ukraine in 2022. So the dollar's international status gives us economic advantages, it gives us an automatic form of insurance, and it gives us geopolitical advantages, I would argue, as well. So what is a happy situation on those grounds for the United States is not entirely a happy situation for other countries. The fact that the dollar has this singular status has been a source of complaints from foreign prime ministers, presidents, finance ministers for many, many years. Back in 1971, when there was a dispute about the dollar status, and when President Richard Nixon, abandoned the convertibility of the dollar, the promise that dollars could be converted into gold at a fixed price of $35 an ounce, Nixon's Treasury Secretary listened to those complaints and, being the blunt Texan he was, responded, "It's our currency, but your problem. You may not like it, but there's nothing you can do about it." I would argue that Connolly might have been a bit more cautious had he been aware that international currency status is not forever. And we can be reminded of that fact by looking back at the international currencies that dominated global transactions or dominated international transactions prior to the advent of the dollar. So we can look back more than 2 millennia to the little owls of Athens. The owl was the symbol of Athena, the goddess of wisdom. These silver coins were the dominant vehicle for international transactions between the state of Athens, other Greek city-states. They financed trade all throughout the Eastern Mediterranean, in portions of the Middle East. We can look to the Roman coins of Julius Caesar and subsequent Roman emperors that financed trade and circulated not only around the Mediterranean and the Middle East, but as far east as present-day Afghanistan, India. They have been found in China. They have been found even in Japan. Julius Caesar famously traveled with a mint so that he could uh, uh, create more of these coins to pay his legions, that he had to bribe them with coins to get them to cross the Rubicon. Um, we can look to the gold coins of Byzantium, the Byzantine Empire, which circulated not only in the Middle East, but across Western Europe as well, and have also been found in India and other portions of uh, other regions of Asia. The little city-state of Florence and its currency, the florin, uh, was the international currency used in trade and payments throughout Europe from the late 13th century into the 16th century. They were important because Florentine money circulated across borders throughout Europe, not only in the coin form that you see here, but as bank money as well. Florentine merchants set up shop in different countries. Once they started to do commercial business, they started to do financial business, transferring funds between their branches in different countries, moving from coined money to bank money that circulated across borders as well. You will have heard of Spanish pieces of eight, which were really the first true global currency, which circulated everywhere, not only in the Western Hemisphere where the Spanish silver was mined, but in Europe, in Asia, from the 16th into the 19th century. Spanish silver coin was the dominant vehicle for China's international trade. Spanish pieces of eight, they were pieces of eight because 8 real made up one Spanish dollar. And when they wanted small change, they would cut up the Spanish dollars into eight pizza shaped, pizza slice shaped pieces. Spanish pieces of eight were legal tender in the United States until 1857, until the eve of the Civil War, because until gold was discovered in California and silver was discovered in Nevada, we didn't have enough precious metal in the US for our mint to produce sufficient coins. So we used Spanish silver coin minted in Mexico or Peru or wherever. The Dutch guilder, the guilder of the Dutch Republic of the Netherlands, um, was the dominant international currency in Europe, but also in Asia with the penetration there of the Dutch East India Company from the 17th century right up until the Napoleonic Wars, when the Netherlands were invaded by France. The Dutch guilder was important because the Dutch built on what the Florentines had done before them, moving from coin money to bank money. But where the Florentines had guaranteed that their bank money could be converted into silver and gold, the Dutch moved to fiat currency like we have today in the United States, where our dollars cannot be converted into gold at a fixed price. And after the Dutch guilder, starting in the 19th century, we had the pound sterling as the dominant international currency. London was the world's money market. A majority of cross-border trade worldwide was financed in London through loans denominated in pound sterling. A majority of global cross-border financial transactions similarly were organized in London and denominated in pounds sterling. So what does this very rapid review of 2,000 years of international monetary history tell us? It tells us that international currency status rests on multiple foundations. It derives from, first and foremost, on the strength of the issuing country's commercial and financial links, how much it imports and exports, how much it lends and borrows, International currency status depends on the depth and liquidity of the issuer's financial markets, and it depends importantly on the presence of a central bank to backstop those markets when something goes wrong. So the complicated figure on the right is a reminder that the US, by most measures, remains the single largest economy in the world, and the dollar's global dominance derives, at least in part, from that fact that US banks and firms do so much international business because we're a big economy. Um, they naturally prefer to do it in dollars, and the desire to do business in and with the United States encourages parties in other countries to use dollars as well. Um, Less obviously, international currency status also has political foundations, domestic political foundations. To start with, international currencies tend to be those of states where there exists a separation of powers, rule of law that prevents opportunistic behavior by the issuer and ensures that creditors, investors have voice. The government and central bank are not free to debase, devalue, inflate away the value of the currency if they so wish. So you can imagine that there is a current political subtext to these remarks. There are questions about rule of law and the separation of powers all of a sudden in the United States. That has implications, I think, for how people globally view the safety and security of the greenback. And again, I will come back to that. In addition, um, there are international political foundations of international currency status. Um, Governments, central banks, and private investors around the world prefer to hold and use the currencies of their trusted alliance partners. They trust their alliance partners not to act opportunistically and seize, garnish, inflate away the value of their holdings. So uh, Japan and South Korea hold more dollars, hold more of their international reserves in dollars than their trade and financial links with the United States would lead one to expect, because they also rely on the US for security, for their nuclear umbrella. So again, you can imagine that um, with that I see relevance of this observation for how people in other countries, how foreign governments view the safety and security of the dollar after remarks made by Pete Hegseth and J.D. Vance at the Munich Security Conference earlier this year, after the questions that have been raised about U.S. commitment to the NATO alliance. So I could give you various examples of this in the case of Athens, going back almost 2,500 years ago. Athens was probably the leading international trader of its era. Its port, Piraeus, was the single most important port. Imports of wheat into Athens were higher on a per capita basis than in the Netherlands more than a millennium and a half later, when the Dutch guilder was the leading international currency. The Greek state, Athens, had considerable administrative capacity. Alexander the Great's territory stretched from mainland Greece far to the east. Athens owls were made out of high quality silver. They kept their weight and fineness basically unchanged for several centuries. And Athens had political and military clout. It had international alliances. It was a powerful seafaring power, the head of the Delian League of Greek states. Or we can reel forward almost 2,000 years and consider the case of Britain and the pound sterling in the 19th century. Britain, of course, was the first industrial nation. Britannia ruled the waves. A quarter of the globe was part of its Commonwealth and empire. The pound sterling was on the gold standard at an unchanged value in terms of gold, basically from 1717 all the way up until World War I. Um, London was the leading international financial center, as I said before, and Britain had the first central bank that recognized the importance of acting as a lender and liquidity provider of last resort, acting as basically a backstop to ensure the liquidity of London's financial markets. So the figure on the right is a reminder of how rapidly British trade grew once Britain began to undergo the Industrial Revolution at the beginning of the 19th century. So that's my capsule history of 2,500 years in 15 minutes. What does this so that's a basically an acknowledgement that when you spend 3 years writing a 350-page book, it feels funny to try to summarize it in 15 minutes. What does this history imply about the prospects for the dollar? There is a lot of chatter, you will be aware, about the prospects of the dollar. I show you a headline on the left here from an investment bank asking whether the US dollar is losing its dominance. And I show you an article from the Christian Science Monitor a couple of months back asking basically the same thing and pointing to a first reason why we might want to worry about the global dominance of the dollar. So there has been gradual, almost glacially slow erosion of the dollar's dominance over the last quarter century or so. So on the right, I show you a couple of measures of the dollar's share of the foreign reserves held by central banks and governments around the world. Back at the turn of the century, the dollar accounted for more than 70% of the global foreign exchange reserves of central banks and governments. Now that number is down a bit down. The yellow line is the relevant one here, slightly below 60%. So that's telling you that the dollar has been losing about 1/2 of a percentage point of its share of global foreign exchange reserves in a year. That accumulates to about 15% over a quarter of a century. The number of countries around the world that peg their currencies to the dollar has been declining very, very gradually as well. I used to actually think this was a healthy development, that as the global economy became more multipolar and less dominated by the United States, it was a good thing that our global monetary and financial system became a bit more multipolar and less dollar dominated. Just like our global ecosystem is healthier with biodiversity, the global monetary and financial system is healthier with monetary diversity, a larger set of different providers of liquidity to the world. So I thought this gradual process of very slow but ongoing rebalancing away from the dollar might on balance be a good thing. Now I'm worried about chaotic flight away from the dollar instead, for the following reasons, um, all having to do more or less with this man. So that starts with Trump's tariffs, the point that the Christian Science Monitor was making before. As I've described, the dollar's dominance derives in part from the fact that the US is a large economy that trades a lot with the rest of the world. And a lot of our trade with the rest of the world is naturally denominated in our own currency, because that's what our banks and firms find convenient. Trump's tariffs are designed to reduce our trade dependence by their very definition, to reshore manufacturing and other things. So there's no scenario in which those tariffs would be a positive from the point of view of the dollar's global role. But that, of course, is not all. There are worries in the United States and around the world about the sustainability of US government debt. So I remind you that uh, the majority of the foreign dollar reserves held by central banks and governments around the world are held in the form of treasury bonds. And this exploding ratio of debt to GDP, which that ratio is current debt in the hands of the public, is currently about 100% of GDP, as I show you here. And the Congressional Budget Office is telling us if we don't do anything, that ratio will explode upward, as you can see in the figure on the right. That is raising real questions about whether, in the minds of pundits and perhaps eventually investors, about the sustainability of that debt and about the possibility that the U.S. government and the Fed, in their wisdom, will inflate away, at least in part, the value of the debt, leading to growing foreign reluctance to hold U.S. Treasury securities because of our inability to agree in the United States on either tax revenue increases or spending cuts as necessary to stabilize the ratio of debt to GDP. And a lot of the things that have been done in 2025, the One Big Beautiful Bill Act, only reinforce, I think, those concerns. There are worries about financial instability. So if you've been reading your morning newspaper, you will have been seeing more chatter about whether there is some kind of bubble in the high-tech sector or in Wall Street. Lots of leverage in financial markets, setting the stage, possibly. I'm not predicting, but I'm channeling what kind of talk is out there of some kind of financial problem, financial crisis, and the fact that what we did to stabilize financial markets after the subprime crisis and the global financial crisis, namely the Dodd-Frank Wall Street Reform and Consumer Protection Act, it was called, of 2010, a number of those measures, like the stress tests that banks are subject to, have been weakened and rolled back in subsequent years. That is not surprising. A crisis happens, we tighten up the rules, and then as memory of that crisis begins to recede, we loosen up the rules, and we end up at some point with another crisis. In addition, there's the possibility of spillovers from the crypto sphere into the mainstream financial system, or as in the case of Silicon Valley Bank, problems in the mainstream banking system, financial system, back to the crypto sphere. One of the big stable coins crashed because it held all of its reserves in 2023 at Silicon Valley Bank. I think there are lots of reasons to be worried about US financial markets, and foreign central banks, foreign governments, foreign corporate treasurers share those worries. There is a lot of chatter around the Fed and about around the independence of the Federal Reserve System. So President Trump's acting Solicitor General has asserted that the president has power over a variety of independent agencies. Trump has asserted that termination of Federal Reserve Chair Jay Powell cannot come fast enough. Trump has appointed his Council of Economic Advisors chair on temporary leave from the CEA to fill an open seat on the Federal Reserve Board. And Trump has attempted to fire a sitting member of the Board of Governors, Governor Lisa Cook, over some problem with her home mortgages. So I'm not going to go into that one other than to say Lisa Cook was my PhD student, UC Berkeley, PhD 1997, and she's going to follow this one all the way to the Supreme Court. Stephen Moran is the person on leave from the Council of Economic Advisors, now sitting temporarily on the Federal Reserve Board. In his earlier incarnation in November of 2024, he was an investment advisor. He recommended slapping a tax on foreign holdings of US Treasury bonds, especially if they were held by countries like China that we don't like, as a way of pushing the dollar down and making US exports more competitive. If they don't buy our Treasury bonds, there will be less demand for dollars and the dollar will weaken. And his argument went, that will be good for US exports. My response to that is be careful what you hope for. They're hoping for a gradual weakening, modest weakening of the dollar. And a modest weakening can turn into a rout if people grow concerned that these policies might actually become a thing. And Treasury Secretary Scott Bessent has mooted the idea that we might convert our 5, 10, and 20-year US Treasury bonds into century bonds that mature only over 100 years, after 100 years, and that we attach a 2% interest rate to those bonds, whether foreign investors like it or not. And again, I think foreign investors would take fright at such a measure. All of these are ideas that have been floated, and international investors are very aware of that talk. And Trump, for his part, has threatened a 100% tariff on countries that actively contemplate steps to move to other currencies rather than the dollar. And I think the more US officials talk about those threats, the more likely they are to produce the very outcome that they're seeking to avert. Most important of all, in my view, is the weakening of US diplomatic geopolitical alliances, which could undermine the geopolitical foundations of dollar dominance. Again, as I said before, central banks and governments around the world hold and use the currencies of their alliance partners because those alliance partners are viewed as reliable stewards of their reserves. If a country is an alliance partner of the United States, holding dollars is a show of good faith on their part as well. So if those alliances become less important or reliable, this geopolitical motive for holding and using dollars grows less powerful. So those are the threats to dollar dominance. The other side of the coin, as it were, is if the dollar suffers, what other asset or assets will benefit? Here are the candidates: gold. Notice the question mark. The euro, the Chinese renminbi. Those two being the currencies of the other two biggest global economies. Other non-traditional reserve currencies that haven't really been on the scene until now. And finally, there is a high-tech crypto-related possibility about which I will explain, a network of interoperable central bank digital currencies. So if there is more dramatic movement away from relying on the dollar, I think there will be some movement toward all of these alternatives, but none of them really has a global footprint sufficient to replace the dollar on the international stage. So gold, everyone will have noticed that the price of gold has soared to above $4,000 an ounce. And one explanation you hear for this out there is called the debasement trade, that people worry that the US is going to debase inflate away the value of the dollar. So they're trading dollars for gold, and that explains why its price has gone up. And the other thing you see is that central banks, specifically the central banks of emerging markets, have been buying gold really since the global financial crisis in 2009. Central banks, the share of gold in their reserve portfolios has gone up because gold has become more valuable, but also because emerging market central banks have been diversifying toward it, buying more gold over time. There are limits to that. Gold is also safe from sanctions. Russia, before it invaded, annexed Crimea in 2014, put most of its gold, which had been vaulted at the Bank of England or the London Metal Exchange or the New York Federal Reserve Bank, they put that gold on the boat and shipped it back to St. Petersburg and Moscow, where it couldn't be garnished. But when you vault that gold at home, you can't use it for payments. There was a famous case where Venezuela, under sanction, hired a fleet of 747s to ship gold bars to Iran in order to pay for oil field services and oil drilling equipment. But the extremity of that case is kind of proof that gold is clunky and hard to use for payment. You can use it in financial transactions as collateral. You can lend it only if it's warehoused in London or New York. So I think there are limits on shifting from dollars, which are convenient for payments, and financial transactions toward gold. Um, the euro was created in part in order so Europe could have an alternative, a rival to the dollar. But the euro has gained no international market share since it was created in 1999. So these lines are various indicators of how important the euro is as an international currency. The European Central Bank publishes a report called The International Role of the Euro every June, and it basically shows it looks like the electrocardiogram of a dead person, right? It doesn't fluctuate very much. The euro hasn't been gaining significantly on the dollar over time because there have been doubts about the survival of the euro. There were doubts 10 years ago about questions about whether Greece would exit the euro area and restore the drachma and whether other countries would follow. There's no euro area treasury. There's no euro area fiscal policy, only French fiscal policy and German fiscal policy. Only 3 euro area governments have AAA credit ratings. Um, uh, Central banks and governments only want to hold as reserves the securities of governments, countries with AAA ratings. Only Germany, the Netherlands, and tiny Luxembourg have AAA ratings. And Europe doesn't have a common foreign policy. The euro area doesn't have an army like the United States. So those arguments about security alliances and so forth supporting the dollar, there is no euro area equivalent. Uh, the Chinese renminbi, lots of people talk about how China is moving rapidly to internationalize its currency, the renminbi, give it a larger international role. Here is the currency composition of international reserves. You've got to squint and look hard at this figure to see the brown slice on the upper right. That's the share of China's renminbi. So its share is growing. It started from basically nothing 10 years ago, and now it accounts for a remarkable full, wait for it, 2% of global foreign exchange reserves, where the dollar still accounts for 57%. The share of global foreign exchange transactions in renminbi is only 1/10 that in dollars. The U.S. Treasury bond market by itself We also have corporate bond markets. The Treasury bond market by itself is 5 times as large as all Chinese bond markets combined. So the renminbi is making headway, but it's starting out leagues behind the dollar, and its share in global transactions would have to grow at double-digit rates for decades before it came within hailing distance of the dollar. Why that discrepancy? It's not a surprise. The United States has been actively promoting international use of the dollar for more than a century. China has been actively promoting international use of the renminbi for a decade. We have been building our financial markets for more than 2 centuries. They have been building modern financial markets for only 2 decades. So, they got a very late start by this measure. And now that the Chinese economy is slowing down, now that nothing in China is growing at double-digit rates anymore, I think the pace at which the renminbi will gain on the dollar is going to slow down as well. So here again, this is global foreign exchange reserves, pie chart version. The blue slice is the dollar. The brown slice is that of the Chinese renminbi. Final fact is that the renminbi's international use has growth of the renminbi's international use is basically stalled out, as you can see here. Everything in China is growing more slowly than it had before. Russia is the main holder of Chinese renminbi. It does its cross-border business now with China using China's currency because it's under sanction from the West. And that by itself is not enough to lift the renminbi up to global status, given that the Russian economy is only 2% of the global economy. It's simply not a big player. Non-traditional reserve currencies. The other thing that we have seen in the last 10 or 15 years is that currencies people didn't used to buy, hold, and use are now increasingly bought, held, and used. So most of the international reserve share that the dollar has lost over the last 15 years has been gained by these non-traditional reserve currencies. Here they are. They're the currencies of small, open, well-managed economies. Curiously, I don't understand this one. They almost all have the name dollar or krona. Australian dollar, Canadian dollar, Singapore dollar, New Zealand dollar, Swedish krona, Norwegian krona, Danish krona. There is the odd Korean won and so forth mixed in there. But these are all small, open, well-managed economies with low and stable inflation rates. And what has changed is electronic trading of currencies. I advise against it, but you can trade currencies on your smartphone at low cost. And, the specialists who are in the business of doing this realize that they can do it too. The bid-ask spread, the price you had to pay to buy and sell these currencies used to be like 4 times the cost of dollar-euro trades. Now the cost has come down to where it's the same as trading the big currencies. So a lot of central banks and governments around the world have begun to diversify away from the dollar and toward these currencies. Finally, what about a network of central bank digital currencies? So you know about cryptocurrencies. Bitcoin is too volatile to be a form of international money to be used in payments. Stable coins, you'll probably have heard about these in the Genius Act. They're supposed to be pegged 1-to-1 to the dollar or another major currency. I have my doubts about whether they will actually remain stable. But the official analog to stablecoins is a digital currency issued by the Federal Reserve or another central bank. Central banks around the world are exploring this possibility. China's central bank has already issued a digital currency that can be dropped into the wallets of individuals and used for payments in China itself. And Asian central banks in particular are exploring the possibility that digital uh, their digital currencies could be used for cross-border, for international payments as well, uh, obviating the need to go through the US dollar, the US banking system, et cetera, when you want to make a cross-border payment. So for central banks, those of the People's Republic of China, the Bank of Thailand, the Central Bank of the United Arab Emirates, and the Hong Kong Monetary Authority have built a digital platform with a private blockchain on which their currencies can be used for international transactions. The Saudi central bank has joined, presumably so that this kind of platform can be used to pay for China's imports of petroleum from Saudi Arabia, uh, doing an end run, if you will, around the US dollar. So the technology works. It hasn't been scaled up yet. The code for this blockchain was written by the Digital Institute of the People's Bank of China. It's a China-led project, and it's a Chinese response to the the worry that China too may become subject to US financial sanctions and lose access to the dollar and the US banking system sometime in the future. It works. Maybe it can be scaled up, but I don't think it's a global substitute for the dollar. The US wouldn't join a China-led project whose raison d'etre is presumably to do an end run around the dollar. And we would certainly discourage our allies from joining as well, although that didn't seem to discourage the Saudis from joining. So I think this could be a partial substitute for the dollar, but not on a global scale. There's a political obstacle to scaling up this project as well. Who decides who gets admitted? What are the governance rules? They decide now when there are 5 members by consensus. Everybody has to agree. But when there are 25 members, are you going to vote on regulations and membership and all that? I think there are real political obstacles to making this thing work. So if there is flight away from the dollar, there is no full-fledged substitute that can step up and fill that hole. What that means is that central banks will hold fewer reserves. They will be able to intervene in financial markets less. Financial prices, including exchange rates, will become more volatile. Cross-border trade and investment will become more difficult to and costly to finance. That, in fact, is what happened in the Great Depression of the 1930s. We had 3 big banking crises in the US. Central banks and governments around the world dumped their dollars, and there was nothing to substitute for them. Global trade and finance became more expensive to Global trade and investment became more expensive to finance. Their volume collapsed. We ended up in a Great Depression. So that is my fear, that if there is this flight away from the dollar, it will be impossible to finance globalization, 21st century globalization as we know it, and that would be a crisis of the first order. So this is a classic talk in economics. I've ended on a gloomy note, but I'm happy, Susan, to take questions and so forth from the audience.
Barry, thank you very much. I am having this global view from you that also includes a really astute overview of history as well. There are a few questions. I would like to ask perhaps the question I have heard, um, well, we know that the investment markets still seem to be growing. They're not showing any decline. Maybe day to day there might be some, but overall there is still growth. And I think one of the things we have heard is that if there should be a big dip, that it might happen quickly. That if there's a crisis, it will, any rate. So my question is, and it's partly informed by today's papers that say that the US passport, which used to be regarded as sort of, the number one passport people moving through in international travel, has now gone down to number 13. That Japan, South Korea, others are being regarded for ease of travel. Are there other signs other than the market that we're in this difficult area of a loss of confidence in the U.S. dollar, the loss of confidence in the U.S. separations of power, our stability, our Federal Reserve's independence?
Well, there clearly are other signs. For example, you hear um, central bankers in other parts of the world uh, saying we feel newly reluctant to put all of our eggs in the dollar basket. Um, European Central Bank President Christine Lagarde has made some comments about how this is an opportunity for the euro. The fact that investors around the world, both official and private, feel this new reluctance to depend so heavily, utilize so heavily the dollar, creates an opening for other currencies, including the one that her central bank is responsible for. We haven't really seen when I talked about the debasement trade, I kind of alluded to this. We haven't really seen a dramatic acceleration of movement away from the dollar toward gold or toward other currencies. The fact that the dollar weakened, it depreciated by about 10% on average against other currencies between January and August is another warning sign, perhaps. The dollar exchange rate moves for many reasons, but one reason could be that investors around the world are growing a bit more reluctant to hold and use dollars. So the fact that the US stock market remains high, but the dollar is weakened by 10% so far this year could mean that people are not so concerned about the growth of the economy or the growth of the high-tech sector in particular. They're still bullish in their wisdom about that, but they are concerned about the dollar, that the stock market goes up, but the dollar goes down. They're worried about Federal Reserve independence and threats there too. They're worried about the government's finances as opposed to the finances of the economy as a whole. So yes, I do think there are warning signs out there. And the fact that the dollar dips each time there is, most recently, Trump threatened China with 100% tariff because of the rare earths
Mhm.
export controls. The dollar dipped by a couple of percent uh, on that day. So that's an indication that um, the dollar in particular is adversely affected by threats to the openness of the US economy and policy chaos more generally.
Right. Well, and that leads us to a couple of the questions in the chat from Kurt and Brian is around sort of the fiscal policy, but also the politics. Um, Kurt asks if there is this, does the 2% of the century bonds, is that is that just confusion on the US policy's part? About what's going to provide market. I mean, so I guess it's asking what is the US fiscal policy in this regard? And then also Brian Murphy's comment about with the administration having a unified executive kind of theory of governance with little separation. Is that how much of an impedance is that to having any fiscal policy that has agility, flexibility, creates confidence, and affects, and how it affects the trade imbalance. Your
Yeah.
thoughts?
So the first question about these harebrained schemes that have been uh, coming out of the administration. I'm sorry for not using more uh, objective terminology. I think there is a lot of learning on the job, and a number of these ideas were mooted early in 2025, early in the second Trump administration, and when markets and commentators reacted negatively, there was some uh, uh, reversal of those, withdrawal of those ideas. I would caution against trying to uncover some kind of underlying logic here. We are all trained to
Right.
think that there is an underlying model that is
Yeah.
informing the policy and economic policy decisions of the Trump administration, where the reality might be exactly the opposite. In terms of separation of powers, um, I argued before that separation of powers, rule of law, um, checks and balances on arbitrary action by a unitary executive, these are things that investors value, including foreign investors, and they are part of the foundation of the dollar's global role. So the more people begin to question the strength of rule of law in the United States, the more examples we see of the executive disregarding the um, powers of the courts or the Congress. I
Mhm.
think the more worried those international investors become. This point, of course, cuts both ways. I'm going to China next week. Whenever I go to China, often I'm asked to speak about this topic. One of the points I make is that every leading international and reserve currency in history has been the currency of a political democracy or republic, where there is a division of powers, there is rule of law, there are checks on arbitrary action by the executive. So
Mhm.
China's efforts to promote international use of its currency are hindered by the fact that President Xi and the Politburo have unchecked powers. So my Chinese audiences listen respectfully. I haven't gotten a response at intervention.
Yeah, well, it is actually, it also does speak to the next question that Richard Hill had, which is who are our allies anymore? And since we know politically those allies are more and more about autocratic governments, and that sort of speaks immediately to that question. There is then a final question from the BRIC countries. If the BRIC countries were to form a monetary system, would that have any chance of competing with the dollar?
On the BRICS, I think they are such a heterogeneous collection of countries that they would find it hard to agree on a system. And if they agreed, they would find it hard to operate such a system because their income levels, their economic structures are so very different from one another. Recall the difficulties the members of the euro area have. They, range from Portugal to Germany to uh, Estonia. They have different economic structures, different levels of per capita income, but they managed to do it. The heterogeneity, economic and political, of the BRICS is infinitely greater than that of the members of the euro area. Your other point, real quickly, who are those friends and allies that we've been talking about? You probably noticed that the Treasury Secretary Bessent just offered current dollar $20 billion in currency swaps to Argentina. That's our ally in this context. I think that is, it's being done on political grounds, right? To strengthen the incumbent president's chances in the upcoming regional elections. In the old days, when we provided currency swaps to Mexico in the 1990s, it was because 10% of our trade was with Mexico. 1% of our trade is with Argentina. So um, the fact that we're aiding Argentina, but not aiding other countries with other economic problems, I think, again, is not enhancing global confidence in the dollar.
Right. I fear we have to end here. But Barry, I so much want to thank you for joining us for this hour. This has been really incredibly helpful, if not chilling. Also want to remember your mother. It was delightful to have her join us, in a talk I believe we were having about the Holocaust. And so it's with great fondness now imagining that we've had two Eichengreens with us. The thing that I'd like to mention to everyone is that next week we will have Barbara Epstein, who will be joining us. She's a emeriti from UC Santa Cruz with an upcoming book from UC Press that will be looking at the impact of social movements. We hope you will join us all then. And please look in your email. We will be sending you a digital copy of this talk that you can share with friends and family. Talk about it. And Barry, once again, thank you very much for joining us. And see everybody, I hope, next week.